Hi, everybody, and welcome back to video number 5 in Chapter 14. When we left off, we were looking at dividend policy, and the types of dividends are going to include cash dividends, property dividends, sometimes called dividends in kind, and liquidating dividends. All dividends, except for stock dividends, reduce total stockholders' equity in the corporation. Okay, cash dividends. You've had some introduction to that in 101 and 1A courses that you've had so far in financial accounting. But the board of directors vote on the declaration of cash dividends. A declared cash dividend is a liability right there and then when the dividend is declared. Companies do not declare or pay cash dividends on treasury stock, as we mentioned earlier. Okay, there's 3 important dates to know involving cash dividends: the date of declaration, the date of record, and the date of payment. So let's look at an illustration. Roadway Freight Corp on June 10th declares a cash dividend of 50 cents a share on 1.8 million shares payable July 16th to all stockholders of record on June 24th. What are the entries to record declaration and payment of the cash dividend? Okay, at the date of declaration, which is here, June 10th, we're going to debit retained earnings for the cash dividends that we declare and credit dividends payable for $900,000, which is 1.8 million shares times 50 cents per share. Okay, then at the date of record, we don't have any entry there at all. All we're doing administratively is figuring out who gets the dividends. Then at the date of payment, we zero out the dividends payable that we established here and credit cash to pay for it. Pretty straightforward, and I think you've had this before. Okay, dividends in arrears. Assume that Citicorp declared a dividend on December 31st, 2025 on its 500,000 shares of $1 par value, 7% cumulative preferred shares outstanding. Citigroup did not declare any dividends in 2024. So what amount of dividends will be paid to Citigroup's preferred shareholders as a result of the dividend declared on December 31st, 2025? Okay, Citigroup is going to pay its preferred shareholders the dividend from 2025 and the dividends in arrears from 2024 because this was cumulative preferred shares outstanding. Okay, so we're going to take 500,000 shares times $1 times 7%, and that gives us an annual dividend of $35,000. So we had $35,000 in arrears in 2024 and another $35,000 of dividends for 2025. So we're going to pay a total of $70,000 in dividends in 2025. And again, companies do not declare or pay dividends on treasury stock. Okay, property dividends. Dividends payable in assets other than cash. Fairly rare that we do that, but it does exist. So we're going to restate at fair value the property it will distribute, recognizing any gain or loss. Okay, let's take a look at an illustration. Trendler Incorporated transferred to stockholders some of its equity investments, costing $1.25 million by declaring a property dividend on December 28th, 2024, to be distributed on January 30th, 2025, to the stockholders of record on January 15th, 2025. At the date of declaration, the securities have a fair value of $2 million. What entries should Trendler make to record the property? Okay, at the date of declaration, we're going to take a look at the fact that these equity investments are $1.25 million. So we have a gain on investments here of $750,000. So we'll debit equity investments and credit gains on investment of $750,000. And then we're free to debit retained earnings for the property dividends declared of $2 million and credit property dividends payable of $2 million on December 28th. Then when we distribute the property on January 30th, we will debit and wash out the property dividends payable of $2 million and credit equity investments of $2 million. Okay. Liquidating dividends. Any dividend not based on earnings reduces corporate paid-in capital. The portion of these dividends in excess of accumulated income represents a return of part of the stockholder's investment. This is unusual. However, it does occur usually with a one-time investment in a specific project, in my experience. In fact, here's an illustration. McChesney Mines issued a dividend to its common stockholders of $1.2 million. The cash dividend announcement noted that the stockholders should consider $900,000 as income and the remainder as a return of capital. How should McChesney Mines record the dividend? At the date of declaration, we're going to debit retained earnings for the $900,000, and then we're going to have paid-in capital in excess of par common stock for $300,000, and the credit then would be the dividends payable of $1.2 million here. Okay, note that the liquidating dividend here, this $300,000, is debited to paid-in capital in excess of par. Okay, that's going to be a reduction. Okay, so at the date of payment then, we will debit dividends payable, that will wash this $1.2 million out, and credit cash to pay for it. Okay, stock dividends and stock splits. Stock dividends. Issuance by the company of its own stock to stockholders on a prorated basis without receiving any consideration. This is used when management wishes to, quote unquote, capitalize part of earnings. If a stock dividend is less than 20 to 25% of the common shares outstanding, the company transfers fair market value from retained earnings. This is how we would do a small stock dividend, which I think you had in your basic financial accounting course. Now, if we look at that, how we would do this with an illustration, the Vine Corporation has 1,000 shares of $1 par value common stock and retained earnings of $50,000. If Vine declares a 10% stock dividend, 10% of 1,000 shares is going to be 100 shares. It issues 100 additional shares to common stockholders. The fair value of the stock at the time of the stock dividend is $130 per share. That's fair value. What entry should Vine make to record the stock dividend at the date of declaration and the date of distribution? So at the date of distribution, we're going to debit retained earnings for $13,000. That's the 100 additional shares times the fair value of $130 per share. The common stock dividend distributable is going to be the dollar par value times those 100 shares, or $100. The remainder will go to paid in capital in excess of par common stock for $12,900. If Vine prepares a balance sheet between the date of declaration and distribution, it's going to report common stock dividend distributable account in the stockholders' equity section as an addition to common stock. Now, at the date of distribution, we're going to debit the common stock dividend distributable here, and that will zero that out, and credit common stock. You'll notice the terminology distributable here. It's not payable. We're not paying anything. We're distributing shares. Okay, so let's look at the effect of this. Before the dividend, we had $150,000, $1,000, $99,000, and $50,000. Now, the parent, the stockholders' interests, we had a 40%, 50%, and 10%. So now we've got 60,000, 75,000, and 15,000 for 1,000 shares total. Now, after declaration, we have $1,000 fair value, common stock of 100, paid in capital in excess of 111,000, and retained earnings of 37,000. Total stockholders' equity hasn't changed at all, still 150,000. And then after we distribute the shares, we'll have 1,100 shares here, some of these two, and paid in capital will remain the same, and retained earnings will remain the same, 150,000. And in total, there's no difference in the stockholders' interests. Although there's 1,100 shares now instead of 1,000 shares. Okay, large stock dividend. If Rockland Steel issues a large stock dividend by declaring a 30% stock dividend on November 20th, distributable December 29th, stockholders of record on December 12th, at the date of declaration, 1 million shares, par value $10, are outstanding with a fair value of $200 per share. What would Rockland make at the date of declaration and the date of distribution? So on November 30th, we're going to debit retained earnings of $3 million. That's going to be 300,000 shares times the $10 par value, 3 million. And that's the 300,000 shares is 1 million shares times a 30%. And then at date of distribution, we'll debit and wash out the dividend distributable and credit common stock of 3 million. That looks like a good place to stop this video. And when we return, we'll take a look at stock splits. Until that time, bye for now.